The same sluggish economy that is sending two-year Treasury note yields to record lows is also hurting stocks. Major indexes down today as well after rising for 7 straight days. That doesn't surprise our next guest, though. For more than 2 years, Stephen Kroll, managing director of Monness Crespi Hardt Co, has been forecasting a struggling stock market, and he joins us now. It didn't look so bad for a while. We had a strong rally. We've had now a rough couple of months, almost 3 months, and you expect us to finish unchanged or lower, really, for the year.
Right. When we were on in December, we said that we thought the market would be flat to down, but there are obviously a lot of names that are attractive. But you have this constant back and forth struggle between the macro, which is difficult with the slowing in China and the sovereign debt issues, and then the micro, which is U.S. corporations are actually in pretty good shape and doing a great job. So on a statistical basis, there are some stocks that are attractive, but I think the macro is going to continue to outweigh. And as you can see in the market, it really doesn't know what it wants to do. You're getting these 3 to 5% moves every other month, so there's really no conviction. The pension plans and the public are disappointed, so it's going to be a continued, volatile, flat market.
And you talk about those pension plans and really the fiscal state of the states, if you will, and the federal government. I mean, Steve, that's nothing that's going to get fixed overnight. So it's this malaise, if you will, stays with us for some time, in your view.
It's going to take a while. Luckily, Illinois did do a short-term bond issue the other day. They got it done. And on the sovereign side, Greece got one done, and so did Spain.
And the market's like that. They interpreted that as good news.
They were the first signs of good hope, but they were only 26-week paper and 1-year paper. When they do 5- and 10-year paper, we'll see how it goes. But as we
it's very short term. I mean, you still expect, for example, a default at some point with Greece.
Right.
As most everybody does, except for John Lipsky.
Well, I can't figure that part out, but I think they're going to struggle because they did pay 485 basis points higher than they would have paid normally. But I think the big issue is that this whole issue with the deficit and coming out of it and the soft patch in the economy is going to take weeks, months, maybe even years to work out of, and we're going to have to take some pain, which is raising taxes and cutting spending, which isn't
Don't say
always
that. Matt might get up and attack
It's not very popular, but it's going to happen.
You want to cut spending. It's clear why you would want to cut spending and raise taxes to solve the deficit problem, but what if you cut spending and cut taxes? Then you could maybe spur some growth.
Well, I think that would be good, but I don't think we have a chance of doing that. I had outlined, just thinking overnight one time, that you do a 25% investment tax credit, which will stimulate some real growth in plant and equipment, which is key to get the corporations in the U.S. that have a lot of cash to spend it. But then we're going to have to raise personal taxes 3 percentage points and corporate taxes and cut defense spending and some of these other issues to get things in balance. The market needs some confidence in where we're going, and it doesn't have that confidence now.
Steve, you talk about that investment tax credit, but does that go a long way in creating jobs? Because everybody we've been talking to over the last couple of weeks says you got to do something to create jobs here. That's the big thing holding the market back.
The only way to get the job number better is to build new plants and get it going. But
so it falls.
It does. It would fall, and it would be not a temporary. It would be a permanent thing. The problem is, I think, also confidence. As we said earlier, U.S. corporations have done a great job replenishing the balance sheets. The consumer's starting to get his act together. It's the governments that have the subprime issue. They just loaded themselves up with a huge amount of debt. Initially, that was the thing to do, but now we have to start weaning ourselves off of this, which is going to take, it's pain first to raise taxes.
So to be clear, I mean, you're not expecting anything to come along and boost investor confidence. You think you're bearish on the macro picture, basically.
Well, I would say I'm not. I don't want to like to use the word bearish because I'm in the stock business. I have plenty of stocks that I like. I just think it's going to be a very difficult period. It's going to take a while to come out of it. And a lot of companies in the U.S. statistically are very cheap. Some of the names that I submitted earlier look, 10 times earnings.
Let's put them up so that people know what you're talking about.
Right.
Our analyst Chris Shaw has a buy recommendation on Air Products. We think with the acquisition of Airgas, whether it goes through or not, is great. Overgroy, our biotech analyst, has a big buy report on human genome, which has this big lupus drugs and a lot of the things that I don't really understand, but we think it's excellent. Our oil analyst, Sal Alaco, who's the oldest and most experienced oil analyst on the street, loves the Canadian oil stocks because of this stupid moratorium program that we have in the United States. I think it's wrong. We've had 14,000 wells drilled. We've had one really bad one. I feel very sorry for what's going on, but we should be continuing to do that, not to fall behind on our energy bill. So we think the Canadians have the only good policy out there, and they have the tar sands, and they have tremendous reserves, and they're exploring those. That's what we need to do. We're going to lose 500,000 barrels a day in 2 years from this moratorium that's going on right now.
It's pretty significant. Hey, Steve, thank you so much, as always. Love to have you here. Stephen Kroll, Monness Crespi?
That's right. Monness Crespi Hardt.
Didn't sound right.
I've been saying it for years.
I know. What happened? Anyway, thank you.